So let's look first at the question of volume. FATCA only concerned US persons. So when a US person had an account in a bank, this was covered by this regime. Whereas the CRS, the Common Report Standard, is affecting all your international clients. So the volume of people that you have to report is massively more. Also a big difference is in a global company, in a global bank or an insurance company, they are affected in many more countries. Because you could say if you only have US clients that are concerned on the FATCA, you may not have them widespread in many of your subsidiaries or branches. Whereas international clients you have everywhere. So it affects more clients and it affects more entities in your organizations. The other point you need to look at is the complexity. FATCA was, if you want, an agreement between a country and the Internal Revenue Service of the United States. It was always a bilateral contract, and in many countries the differences between one contract and the other was not so different. And you always had the same counterparty at the negotiation table, which was the IRS. Now looking at CRS, it's much more complex. It's made up of many bilateral or multilateral agreements. Multilateral in the sense that a non-EU country is able to close an agreement that will cover all European countries, or a bilateral agreement, say, between Singapore and Switzerland. So you can imagine there is about 100 countries that have signed up to the CRS, and each country must negotiate a bilateral agreement or a multilateral agreement with another country. So you have hundreds of agreements. And the effect is also that we have seen it differs. While many countries adopt the OECD standard, you have many countries that differ from that standard. So this makes the implementation of CRS much more complex for a global bank that is exposed to many different contracts in many different countries. So let's look at it first from a technical or IT point of view. A big question is the IT architecture, or say the functional architecture you want to have built up around CRS. You have to see that banks were already confronted back in 2002 with the Qualified Intermediary Agreement. In 2012-13, FATCA was implemented, and now CRS. The underlying data is often the same, yet companies have started to build tactical solutions, so kind of a spaghetti thing in IT. So a lot of banks and insurance companies look more strategically now on how to organize themselves around the IT. Yeah? One big question is, for instance, your deployment model within the IT. Do you want to have regional data hubs from where you would draw the data to report? Or do you have a strategy where you leave it to your subsidiaries in other parts of the world to define their own way on how they want to organize the IT around the reporting? So another aspect, and is usually the biggest even, is the quality of the data. And then also the consistency of data. As I said, for QI, FATCA, CRS, often the underlying data that you have to report is the same. So you really want to make sure you really report the same figures under the various tax regimes. So that means the data consistency. And again, it's a question of how do you organize across the bank or the insurance company that you have a consistent data hub, a data mart, and the data quality itself. So that's also usually a huge undertaking, because for many years a lot of the financial institutions were not too concerned about information that they suddenly have to report now under these tax regimes. So to make sure that the data is up to date is a huge challenge. So from an operational point of view, it's a bit the same as in IT architecture. Do you have a centralized model, or do you have, let's say, a deployed model? Do you have a single unit for an entire organization to look after these different treaties and the reporting? Or do you want to have satellite teams, let's say in Asia and the Americas? Or are you able to centralize the data and to do it from a single spot? So from an operational point of view, also processing the reporting is very much a question of how you organize the actual doing. Yeah, I would say these are the major challenge. And of course, what those financial institutions that have now already started to report FATCA, they realized that only after 1 year already there were changes from the IRS. So under CRS, you will have changes from many tax authorities. So how do you organize yourself to keep track of those changes? That's another big challenge for the ongoing maintenance of the, let's say, the compliance with the local rules that can change. Okay, so let's start with the core business, the front, dealing with your clients. Of course, it has an impact. Now that on the FATCA and on the CRS, all these international clients are now tax transparent. So that means they will have to report their income and capital gains from the wealth they have in any parts of the world. Now, during the advisory process, so the relationship manager may have now a close look to what kind of assets he is proposing to an investor, because a particular instrument, a particular share or a bond may be tax-wise not as efficient for a German investor as for a UK investor. So you have to take into account country-specific, let's say, impacts an instrument can have on your taxable position. So it will affect the advisory process, and in the same way, it will affect the portfolio management process. When you do rebalancing of portfolios in the future, the notion of post-tax performance is much more relevant than it was in the past. Your investors will want to know now, how is my portfolio performing, taking tax impacts into account, yeah? Which means that you may have to offer simulation services, so that when your investor wants to ask you, well, what about losses from previous transactions? Can I carry that forward into the next tax year? Should I use it today? So can we simulate an effect on tax when I sell this or that? So financial institutions may get more and more, let's say, involved in optimizing from a tax point of view what is legally possible, the investment strategy of the clients. Now let's look again at the operating model. I think I touched upon previously. Again, it's a question of how do you organize yourself around the process of delivering the tax reports. At the end of the day, this is the final piece, and information that has to go to a local tax authorities. Do you want to do this in each location? Do you have a separate team looking after that? Or do you have a centralized data hub where a decentral team can get access to the data, load it into a local system, and then process the data? One critical element in the whole reporting of CRS is the fact that you now need to deliver, also it was true on the FATCA already, the name, address, birth date, so client-sensitive data. A lot of financial institutions have this data separated from the account transaction information, and only limited people in the organization have access to client nominative data. So, but you have to report them. So you may have to change the process by which you combine the client-sensitive data together with the transactional data, so that you can still be sure that the information is not too widespread in the organization and only limited people have access and knowledge what kind of person is behind the transactions. It's kind of an important point to consider. So one further point on the client management side, or the client or the advisory side. Interestingly, we had this discussion yesterday with a bank in Switzerland, and it was the head of tax who asked the question, what about reconciliation of data from different treaties or from the actual country tax treatment to the information you can find on, let's say, your account details. So under CRS, for instance, a bank or an insurance company will report the sales proceeds from a share sale transaction. So when you sell Coca-Cola shares, you will get an amount of money depending on the price on the day you sell. And this is the gross proceeds. It's before you add any charges and so on. So the tax authorities get a sales proceeds. Now, when you look at a country-specific tax report, actually the figure there you take into account may not be the gross sales proceeds, because you can net these proceeds already with incurred costs, which will have an effect on, on the proceeds you get. So the client will have difficulties to reconcile one figure the bank is reporting to the tax authorities from another figure that he gets in his tax report. And yet the underlying transaction is the same. It's the sale of Coca-Cola shares. So how do you reconcile these different data, which for itself in each regime are absolutely valid and according to the specifications of the agreement, but the client does not understand it. So he wants to know, what are the differences? What, if I may ask, by the tax authorities and so on. So this is an interesting question, and probably a huge challenge to make this reconciliation so that each and every relationship manager is able to inform on a very simple basis his client or her client about these differences. The answer is yes, it is an option, but from our observation in the market, it is not really not even in an early stage. A lot of financial institutions look at the option, it's clear. They were not yet there when FATCA was coming, because FATCA, again, the volume was not so high, not a lot of entities were concerned in your organization. Now the CRS is changing, a lot of volume, a lot of entities, so high complexity. The question is your organization already, let's say, experienced in outsourcing? So do you have outsourced other parts of the business? Are you able to deal with outsourcing providers? If you don't have the experience and you just do it now for a CRS reporting, it may not be so efficient to start. The topic is nevertheless quite complex. Another key question is the client-sensitive data. In the file that you have to transmit to the tax authorities, the name of the client, the address, the birth date, the TIN number, the tax identification number, so very sensitive data is included in the record. Now, can you give this outside of your organization? Can you be sure that the outsourcer has the data center in the same country? Or would your nominative client-sensitive data leave the country? So you have data secrecy issues that you need to look at. Now, of course, you could just outsource, let's say, half of the reportable file, which is the account, the balances, the incomes, and so on, to get the file then, let's say, half-baked back from the outsourcer, and then you add the nominative information. But then I would question the efficiency of that. Another thing is the data quality. If your data quality is not good, it will have an impact on your outsourcing cost or on the SLA. The question is, who is controlling the quality? Who is cleansing the data? Is it the outsourcers? Is it yourself? So if it is yourself, then there is a lot of back and forth between the outsourcer and the organization until the data is really in a good quality. So the outsourcer can, without a problem, produce correct results. So, but on the other hand, that raises the question, if your data is really of high quality, why do you want to outsource? All you would need is a tax reporting engine, such as BearingPoint's FATCA solution, where you just can transmit the data to, and then the solution is taking care of all the regulation or the tax law matters, and produces with your data all the required report files, more or less at a push button. Yeah, I tend to say, if your data is correct, which in the end it must be for an outsourcer, you don't really need an outsourcing company. If you can entrust then the final part, the reporting, to a vendor solution. So these are things that you have to consider. And I would say a final aspect is consistency. In our view, it would not make sense to do, let's say, the QI or a FATCA reporting yourself in the organization and outsource CRS. If outsourcing, then everything should be outsourced, so that again you have consistency in the data under the various tax regimes that your outsourcer must now take care of. And likewise, when you provide the clients with a country-specific tax report, you also should outsource this, because again, that helps then that the outsourcer has the data consistency also to the regulation part of the reporting on the CRS, but then when your client wants a client-specific report, also that the same data is used. So these are the main topics you must address before you decide to outsource. Well, what is really coming next, for sure, are changes in the existing tax treaties. I mean, BearingPoint is doing QI reporting with FATCA since 2002. And every year, a little bit changes. A new income code, another one deleted, a new aggregation, a new data field that is required. So and also the format of the report itself changed a lot of times over the years. FATCA, the same. The treaty was not in place for 1 year. We already had first changes, and it will happen in CRS. CRS reporting has started a few months ago this year for the Wave 1 countries. But you can always be sure that many of the countries, when you have to report next year, same time, some things will have changed. So that's the first thing. Is a new treaty on the horizon? Yes, there is one. It's called TRACE. It was put in place in 2013, and slowly financial institutions start to shift the focus now to TRACE. TRACE is to improve the relief for withholding tax. So, let's say a German who receives dividends from a US company does not get the full amount of the dividend. A part is held back, a so-called withholding tax. And under the double taxation agreement between Germany and the US, you can partially reclaim part of the withholding tax. Now, this is a complex, often paper-based process. You have specialized providers or the bank itself who provide tax reclaim services to clients. So you can go to your bank, you must provide a lot of paper and proof that you are the holder of the investment and so on to eventually get back some money. So TRACE will more or less automate this whole process, and you can get your relief immediately at source. It will have a huge impact on the whole chain, how securities are processed, from the issuer down to the investor. When this treaty will actually come into force, nobody knows yet, but it's getting, let's say with CRS, in a year from now over, the focus will shift on that. And finally, not a regulation itself, but what we will see, what is also coming, your international clients, given the fact that they have now to report all the assets they have abroad in the home country where they live, they come to you and ask a client tax report. So that's where, for instance, BearingPoint has Easy Tax. That enables then the bank to give your German client a German tax report, your UK client a UK tax report. For this person, for this investor then, to have a cost-effective way to file his tax in his home country. So this is already increasing the demand for such a service. And a lot of banks, especially the wealth managers, private banks, have started to offer it. So your competitors offer it, so you must also offer. So there is a positive spin now. And although it's not a regulation, a must, it is almost a compulsory service that in the near future you simply have to provide.